The second part of what we're going to introduce is going to be rather unique because of today's industry. As a young kid that came over to this country from Korea, one of the first movies I watched was Gone with the Wind. And I remember this character, Rhett Butler. And Rhett used to always say, and he, the times were like troublesome and all these things, bad things were going on. But he was so happy because he made money during those times. And you have to think of that today. Sure, rates are high, economy, it's a lot of, just, I could go on and on about what the government and government officials and everyone across the world kind of did during COVID and how they bailed themselves out and they lent too much money or poured in false money or fake money and put us in a situation, but we can't sit there and complain too long. We need to move on. And so opportunities today that are going to be unique is one is because we have money as a lender, you're going to stand out above anyone else that's looking for funding because we have money that we can write. So right there, rates are not going to be your enemy. Leverage is not going to be your enemy. It's really not. It's just a matter of the client making sure that they have enough margin to cover the carry costs. And that's upon them to make sure that they go into a profitable situation. How we cover ourselves, we don't want a lot of defaults. So we might have a formula within our LOS that tells people, hey, you're not making enough on this project to make it worthwhile because your carry cost is going to be too high. So we're training people on how to make a profit at the same time of funding them. So we don't want to put someone in a negative situation. So with that said, all those notes that we wrote back in 2021 and 2022, which I was telling you was our best years, well, take us and multiply that by 1,000 other lenders. That was their best year too. What has happened though, is all those property and all that inventory, all those new houses. I'm sure wherever you guys live, you saw subdivisions and houses being built left and right. You've seen a lot of renovation projects. You see people like tearing down hotels and motels and turning them into apartment complexes. You see a lot of stuff going around in each of your neighborhoods and in areas. Well, what has happened though is the rates are so high and the carry costs are so high that for those bigger developers and those bigger builders and investors, they had to put a kind of a halt on expanding. And that left a lot of inventory out there. So with the inventory that's out there, we see a lot of distressed notes and close to defaults, which opens your opportunities for the buyers, the people that want to buy those properties and to offer financing to buy them. And we'll go over strategy on each type of lead and what separates us and trying to go over tactics. And that's, be future classes where we'll go over tactics. Because you're really going to be the solution for all these investors and borrowers and everyone else that'll be calling you for money or that you'll be meeting because they all need it. They all need the money. Now, because we wrote those notes, segue back to this, is we wrote those notes, we have a lot of defaults and not a lot, but quite a few, more than what we usually have seen. Defaults and delays and distress opportunities because many of the notes that were written 2 years ago were at incredibly low rates. And they basically have to halt on a lot of projects. So this gives us an opportunity. It gave us an opportunity for us as I'm putting my investor hat on now, not my lender hat. So I wear two hats. There's a lender hat, we lend on projects, but then there's the investor hat. The investor hat looks at it as this. We have opportunities to build to rent because renting is obviously a lot more profitable these days than buying a house because the interest rates are too high. So you're not going to get a lot of buyers of houses. and applications and mortgages and et cetera have fallen in 2023. But rental income has increased and rental opportunities. And I don't know about all your areas, but rents are at a good pace. So we look for, and this is another strategy that we can have down the road, but we look for those 1% and higher opportunities. And I'll tell you what that means. It's simple. We're trained with this. You see a house or apartment or a condo is 300,000. If the rent is 3,000, you should jump on it. That's the 1% rule. If you see a house for 200,000 and the rent is 2,000, jump on it. That's the 1% rule. You're seeing more and more opportunities on that 1% rule. So for many of you, you're going to find opportunities. You might run into opportunities for some of your investors, some of your buyers, some of your builders. And for us, we look at opportunities where we can take over developments or do our own developments, get the cost basis on developing these, and utilize Sequoia members as our exit strategy. And what I mean by this is this. For example, I'll use one of our fourplex developments that we're doing right now. And maybe I could put an image. I'm going to try to share screen, so bear with me, okay? 1 second as I put it together. So I'm not good at this. All right, so we put these unique opportunities where we purchase a lot of the inventory, and we purchase the inventory on cost basis. So because we wrote the loan, we know exactly what the builders and developers had to pay to build those structures. It's a big advantage for us. So we know the stress limit of our customers. So we have an opportunity to purchase these rental properties that are cash flowing very well. And for those of you that know cap rates, minimum, I go in on a project as 8% cap to double-digit caps. Incredible profit scenarios. We are going to build and acquire these and give the opportunity to our Sequoia members to resell some of these properties that we have. They'll be off market. They will be not listed. They'll be acquired by us. Or we're going to set up a fractional share program. And a fractional share program, which is very, very exciting, is this. So many of our friends, many of us in general, don't have $500,000 to $1 million to buy in a couple of these rental properties and developments. But we might have 20, 30,000, even 10,000 that we want to put into a fractional. So with a lot of these units that we're purchasing, there'll be cash flowing rental units that are new and that have a nice cap rate. And now with that fractional share, you can buy 5% of a project or a property, make 5% of the income and the NOI on a quarterly basis, and still get the 5% appreciation of that property. So it's a win-win. This is very unique. I'm sure a lot of you heard of fractional shares, and even on the equity market, there's fractional shares of companies, but this is fractional shares of real estate projects. The great thing for you guys is, since Alan's a good friend of mine, that all of these are not going to be put on the market. They're basically only going to go through Sequoia reps. So in order to put a fractional investment or to buy any of our property that's off market, you have to be a Sequoia member. So you might introduce it to someone that you know as a buyer or a potential buyer, or they have to get a membership and they'll be underneath you, whoever brought them in. So we're not looking at building a $1 billion fund. No, we're going to, myself and a few others are putting together probably a portfolio of $10 to $20 million worth of properties that are cash flowing, and giving them an opportunity for you guys, and then Sequoia to grow this. And sure, we might be $1 billion in a couple of years, I mean, who knows? With how fast Sequoia can grow, um, we're going to basically reutilize the investment money and buy more properties. And at the same time, what we're going to make it real easy is for every investor, what do you guys worry about? Well, how long do I have to keep that investment in there? And when can I get the money out? We're going to make it where you can get your money back within 30 days. So your investment's not in there very long. Our caveat is this, that your investment's going to be making you quarterly payments every time. You're going to get part of the rent. You're going to make, you're going to understand how property management works. You're going to understand everything about the property that you have fractional ownership of. We predict that just from other models, that I would say about 80% of the investors are going to keep their money in there because they're making a return on their current money rather than having it sit at a bank or them use disposable income using it somewhere else. So most of our clientele are going to be people that have jobs in other areas and utilizing some of their disposable income for real estate and opportunities. And only Sequoia will be able to introduce that. So it'll be very unique and very safe. You're only making profits on your money. There's no, you don't have to have the negative side of real estate owning, means don't have to worry about leases. You don't have to worry about listing it with the real estate company. Don't have to worry about insurance, taxes, all this other stuff. Of course, you have to worry about your own taxes that you make income from, but from the property itself. So we're going to make it very simple. And, we're working with the attorneys and getting it all set up structurally. So we'll have all the legal documents, but everything will be app-based. So as a Sequoia member, you'll be able to introduce the app and then have people invest through the app. So I'm very excited about that. I think it's a very, very unique way of sharing some of the rental properties we can get right now. In a market like this is a buying opportunity. In a market from 2 years ago, that is a selling opportunity. Okay, so keep that in mind. Right now, it's a buying opportunity. You can choose the properties that you want carefully, but there's a lot of good rental properties that are out there that are making very good money, and the property itself is stabilized and not really appreciating in value. And the reason why is because when real estate agents or real estate brokers, when they sell properties, they go by comps, and your appraisers go out there by comps. Well, if no one's really selling, well, then the comps they have to use old comps, and no one's really buying, so they're going to go by prices of properties where people felt like they had to lower their price of their house to sell, which just kills the market. And that's one of the reasons why we're not going to list our properties. We're going to let individuals like yourselves and people that have opportunities on these properties, either by brokering them, selling them, buying into them, or even, expanding. So that's kind of it in a nutshell, Alan. If you want to open up for questions and answers, Q&A type of session, that'd be great.
Sure, absolutely. So again, that is just some overview about what we are doing in the back end, because a lot of the members are seeing us, hey, you guys just doing commercial lending, but actually Sequoia is not just a commercial lending company. There's many different type of vertical that we are actually building right now. So real estate investment is one of it. And Jason, I know Dylan is not here tonight. Mr. Dylan Nguyen in San Jose. He is going to be actually heading the property management side also, because when we are purchasing all these properties, who's going to manage it? Who's going to, run this operation? So I know that Jason, you've been talking to Dylan also. So can you
just talk to him this afternoon?
Right, just talk to us a little bit about the management side of it, because I know a lot of this property not just going to be a long-term investment. Some of the property we might choose to do it as an Airbnb, and I know that we are purchasing a motel also, right? So again, talk to us about that.
Yeah, I spent a couple hours on the phone with Dylan this afternoon, or earlier today, and we're going. I'm actually flying up there to Silicon Valley Monday. So I'm spending 3 days with him and his team. So basically what we look at it is this, is the app. It's all app driven. Okay, so we got to get with technology of today. So the app is going to serve two purposes. One is property management, and the other side of is investor management. Okay, so property management, basically, it's going to have everything at your fingertips, except for we're not going to give out any private information of the tenant or who's in the place. But you get to see everything else: costs, the term of the lease, the payments received, payments behind. You get to see everything. It's basically you get to see your own project. Okay, so he's setting up an app with his team that gives you an insight on, as an investor, on all your properties, as a property owner, all of your properties. Now, the investor side, and this goes along with Airbnb and the hotel. So think of each one of those as almost like a asset class. So we're going to have rental properties. We're going to have Airbnb short-term rental properties. So you have your traditional rental, which is a month-to-month basis, and then you have your short-term, which is Airbnb. So we're going to see how much access we want to give to on the short-term rental, which I want to. That's more of Dylan's expertise, so he's going to show it to me. But you get to see the scheduling. You get to see, because you're going to have fractional ownership of the Airbnb property also. And then the same thing with, so think of a hotel motel. They have a couple going on right now, one in the Bay Area, one in Modesto. Think of it as a large scale Airbnb, right? Because you got rooms, you got rental rates, you got how many of them are being rented on a basis, on a nightly basis, weekly basis. You get to see the rates, you get to see some of the other comps in the area. So these are unique, but I just look at them as a larger short-term rental. And the great thing is on the investor side is that you get to look at your portfolio the same way you would look at your property. So think of a property as inclusive of one individual unit, right? Property manager, my one unit. Think of an investor as many units. So you could actually, let's say on a $10,000 investment, you could be a part of 10 different units. You could put 5,000 into the hotel and 5,000 into 4 or 5 different properties. So basically you're spreading out the areas that you want to do. And maybe we have properties right now. I'm focusing on Texas and Dylan's doing California, but I know Alan's out there in DC area. Maybe you're like, oh, you know what? I like my area. I like Florida, or I like Texas. So as we bring in properties that that we've already done our due diligence to make sure that they're profitable, you might say, hey, I like, let me put a little bit into this Texas property, a little bit into Florida, and a little bit into this California hotel. So those are the choices you get to make. But at the same time, the app will also give you a high level view of all the units that you're part of, and then also will give you does your taxes, the K1s, everything else that for those of you that have done investments. So all the necessary documents, all the legal, everything else it's going to be app based, but then real time you can see your properties. This is a good way. I liken it to like fantasy football. I'm a big fantasy football guy. So basically you're picking your players, you get to watch them, you watch the stats, and then at the same time, you might move a little bit of your money to a different property down the road. And we're going to try to make it as easy as possible within the SEC and FINRA guidelines.
Okay, great. So we do have a few questions right here. Arturo is asking, do I need to have an LLC for lender and investors? Yes, for commercial lending, you do need to set up an LLC. And as a matter of fact,
the borrower,
yeah,
or him?
The borrower. Do I need, I think him.
No, he doesn't. The borrower does. Now,
all right.
Now, what we will do is, Alan, I think you're probably the one that would paying most of the people through Sequoia, right? Do you send them, do you send 1099? Do you make them to be an entity, or do you do individual?
Yep, 1099. Our
Okay.
1099, right?
So you could basically set your own company up if you want to do, but you could be your own self-employed and use the same tax ID as your social security for your business. So your business will be, whatever brokerage or uh, John Doe's company, John Doe's lending company. You could do anything you want, but you don't need a license in most states. Now, there are some states where you lend or you will need a license, but most likely those states we don't lend in, like South Dakota, North Dakota. We tend to not lend there. It's a little difficult for you to lend money there.
Mhm.
So there's a few states that we won't lend in.
Okay.
What I'm saying is he was saying that in order to get a loan, you have to have an LLC to get a loan.
Correct. The borrower does. Yes.
borrower.
We only lend to entities. Correct.
Remember, this is a business loan. It's not a personal loans, right? Or you're purchasing an investment property, and it's supposed to be under an LLC. You're not supposed to own an investment property under your own personal name. It's all for liabilities, for privacy issues. Okay.
You get a Delaware corporation in a day. Okay.
Right.
So it doesn't take much. It might cost you $300, but it gets you a Delaware corporation in a day. So it's not too hard. And the other side of it too is if you're talking about exposure and risks, wouldn't you want that LLC just to have that one property? So some kind, it's somewhat like a SPE, special purpose entity. So in your case, or the borrower's case, they're putting that one property under that LLC. So it'd be 123 Main Street LLC, for example. So they have liabilities just for that one property.
Oh,
Okay.
so it's best to do LLC for the lender and the investor, or just
Both, yeah. It's safe for both. But I'm
Okay.
looking at it as the investor. Why would you want to put it on your personal name? Because if you default, a lender could go, when someone defaults with us, we just go after that entity and the asset that we have first lien on. We don't go after their personal. If you put under your personal name, like your house and all the other things of your regular mortgage, you're liable on a
So
bigger
you can't
scale.
do, so you can't put the LLC under the lender and the investor together. You just have to put it separate.
Maybe I'm missing your point. There'd be two
What?
different entities, but correct, there'd be two different entities.
Okay, two different entities, so they gotta have two different LLCs.
Yeah, but you're, as a lender, oh yeah, are you talking about yourself as being a lender or broker?
Yes, yes.
Okay, you don't have to set one up. You could basically say you're self-employed, but when Alan sends you tax 1099, they're going to say that you're not an employee. You're basically self-employed, that you
So-
have your own business.
Yeah, let's not
Okay.
let's not get this thing too complicated. Just remember, we are lenders, right? So we only lend to LLCs. Now, how do you set up the structure and things like this? I would suggest you to talk to your CPA. It's a good idea for you to have an LLC set up anyway, to do any type of business. Okay, so let's move
Yes.
on. Let's move on to the next question. It's from Richard. He's saying that how many doors? And I believe, Jason, we talked about to at least 1,000 doors in the next 5 years.
Oh, how many doors do we want?
Yeah.
Well, okay, so for those of you that have maybe done some bigger scale investments or known about these, the holy grail within any big fund that buys properties, except for maybe BlackRock, okay, they kind of screwed up. But for the most part, you want to get to a number where institutions and REITs, real estate trusts, right, buy your property. So usually that number is like 600 to 1,000. So Alan might use 1,000 because once you get to that scale, people buy your properties at a 5.5 cap. Because remember, these are monies that are in insurance funds, different trusts, etc. They're not. They want to make a good return, and 5.5% on your money on a great asset like real estate is a great opportunity for them. It's good for all your retirement accounts, etc. When today's bank that you could get 5% on deposits, that's an anomaly. That's not normal. Okay, so remember that. So if someone comes back to you and say, "Oh, I can get 5% from my bank on a savings deposit," yeah, right now, but that's going to change. As we know, most of us grew up. You're getting anywhere from 0.5% to 2% max. And short-term money market is in long-term money markets, et cetera. So this 5% is very short-term. But for real estate, 5 to 5.5 cap, as they say, 5 to 5.5% returns is enormous. It's great and that's what we want to do. We want to, so the short side of it is, as an investor, you think of it this way: buy it at between 8 to 10 cap and sell it at 5.5, 6 cap. So if you ever want to see what the tea leaves are saying, when I should do what, buy it at 8 to 10 cap and sell at 5.5 and 6, and just stay with that formula, and you'll have a very happy life.
Okay, well, next question, you got to move on. And also from Richard is saying that, hey, after we refinance the property and take the money back, and do they still keep the percentage ownerships?
We have what they would call is, if you look at how stocks work, the equity markets basically said, so there's a bid ask, and then there's the sell price, right? So there will be a sale price that's on yours that's above the amount that you paid, so you're making a profit, and that's what it's going to take for us to sell your property to a bigger organization. So basically, we are in turn, think of it as that's your portfolio, but we're actively looking to make you a profit on that, because you could put your monies into another property if we sell that one and make you a profit. So our goal is to acquire enough from the distressed situations right now at a great rate, because we have capital and they don't.
Yep.
And then sell it, and then let you make money, and then put your monies either into cash out, take the cash, or put into another rental property.
Okay, good. What is the time frame for something like this to launch? And will these projects be available for retirement fund investments?
No, that'd be on your own. We're not going to get too much into broker dealer / FINRA / Series 7. We're going to try to stay within what we can control. So that money in terms of putting into a trust, putting into retirement funds, et cetera, we're going to leave that to you and your broker or your financial institution that you're going to create your retirement plan. These are very, basically, think of it as a syndicated, it's basically a timeshare syndication, if you want to say, because it's very short term, meaning the longest we'll probably hold it is 5 years, but we might only hold something for 6 months. If we buy something, for example, we buy something for 140,000. So like Al and I, we bought 3 properties, 140,000. If we get an offer tomorrow for 160 each, why would we not make the $20,000 profit on each one? What are we trying to prove?
Right.
We could hold it for 2 more years and maybe we make an additional 20,000. No, take the profit and move on to the next one and acquire more.
Okay, great. Well, when is the time frame to launch? Actually, we are already buying property as a company. So right now, Jason is working with our attorney to come up with all the legal documents. So when that is set in place, then we will open it up. So hopefully we can launch this thing.
I'll say by the first of the year, guys, to be frank, because putting it up to subscription and getting through legal and doing everything else, how attorneys work. They say within 60 days, but I've been down this road, and I'm too old to put to say that we're going to have this ready in 90 days. I would say that we are going to acquire properties from here until the first of the year, but I want to launch the fractional programming probably January 1st or somewhere on the first week of January of 2024. But in the meantime, we'll still actively look for properties to acquire. We are still going to develop. We have right now over 200 units that we're building and expect to be finished before the end of the year. So that's 200 more that we're going to have within our stable, if you want to say. Mm-hmm. So that's our goal for right now. But I want to just kind of give you an idea how exciting it's going to be next year. We start acquiring all these properties on low end because you guys have firsthand knowledge or work directly with lenders. You indirectly are able to acquire properties as a whole group and then have them available by the beginning of next year. and fractionally sell them, own a piece of them, and make money from the opportunities that present itself right now.
Okay. Is that a set amount that have to be to invest? Or
No, I try to make it as easy as possible. So even if, because I grew up poor, I mean, our family in Korea, we couldn't afford a bowl of rice back in the 70s. Okay. So, we have to go back to our roots. Give someone, my kids are in college, I teach them every day, put $1,000 into real estate. Okay. We want to make it that simple. I mean, we probably will have a minimum, maybe 1,000. But I want to make it as simple as possible for someone. And 1,000, for example, or it might be 1%. I'm not quite sure. I have to talk to the attorneys. It might be 1%, but if it's $1,000 minimum, so that means properties that would be or opportunities like some of the townhouses are under 100,000 a unit. Alan, we're working with the attorneys to and even the builder to make the fourplexes into 4 individual condos.
Right.
So then each condo is 100,000 or less.
Right.
So then the 1% rule would work for someone that can invest as little as $1,000.
Right. Okay. Very good. Is this only national or international?
It's going to be international because I raise capital internationally. Obviously, being Asian myself, I typically raise money from China, India, Korea, and the Philippines. And we want to make it accessible to those that want rental properties here in the States. They do not come out here, every year. So for them to be able to put some of their monies into real estate in the US is a lot safer than anywhere else in the world. So we are going to open it up, and it's a lot easier for those of you from other countries. Sure, a lot easier to put 100,000 into real estate projects here in the US than try to move $1 million into starting your own development. So we're trying to make it easier for them to put into some of our properties that we acquire. And I absolutely would tell you, especially for those of you that are from different countries, to start talking to some of the people over there and get to know some of the brokers and present these opportunities over there, because I think there's a lot of money to be made for you. As remember, they have to be a Sequoia member, so you get some money from there, and then we'll have some kind of finder's fee on each share that's bought. It might be not a whole lot, but it adds up over time.
Great, wonderful. Well, it looks like we still have a lot of questions. I don't think that we have enough time to answer all of them, so let's just pick one more. Is this text as short-term cap gains?
I'm going to let you talk to your accountants about that. But if you do anything within a year, then it's a short-term cap gains. If it's over a year, then it's not. So I would definitely talk to your accountant on that. But I'm sure there's ways that you could work with your accountant, because these are not your typical real estate. So you're not going to have to pay the 40%. But it'll be typical like earnings that you make. So it'll be closer to the 20% normal. But
Okay.
definitely talk to your accountant on that.
Okay, great. Well, thank you, everyone. It's 9 o'clock already. So again, we normally stop shop right here. So thank you so much, Jason, for sharing with us. And again, Jason, it's our Sequoia training director. So the certification class is going to come out, and hopefully that is going to come out within the next 30 to 60 days. So depending on how fast marketing can get the video out. So once that is out, we will push it to everyone. And we do ask you everyone out there to do take the certification class. So it will be benefit you regardless what industry that you're in, especially for the lead generation module that Jason is going to put it together. Okay. So, and also another announcement, just remember, we put in an extra trainings. So from now on, every Friday, noontime Eastern Standard Time, noon Eastern Standard Time, that is 9 a.m. Pacific time. We have another Zoom like this, but that Zoom is for Q&As. It's for answering your questions. Bring in your questions, because on a day-to-day basis, we have a lot of phone calls from, you know, all the team members asking for all kind of questions. So many of those questions are actually very similar. So we decided to have what we call lunch with Sequoia. Now, obviously that's for the East Coast people. For your West Coast people, it's going to be breakfast with Sequoia. Okay. So you guys come online, bring your questions. So in that training, it's not just me. We will have other leaders online to help to answer questions. So for example, we might have Lynn from California to join us. Lynn, I'm going to introduce her to the team. She has been in the lending industry for a long time. She knows the lending industry very, very well. We have Bobby going to be online. Bobby is an insurance agent. He has an entire insurance brokers came on board with Sequoia, and he can help us to build our team. We have Mr. Gio. Gio is a mortgage broker that he owns his own team and doing residential. Now he can also help us on different type of loan and things like this. So obviously I will be online also. So again, every Friday night, every Friday noontime, we have lunch with Sequoia. Bring your questions, come online. And now one thing that we do request when you come on the Friday noontime, we want to see you. Okay, so do not hide behind that screen. I want to see a live face. All right, ladies and gentlemen, that's all we have for tonight and another episode of Sequoia Training, and hope you enjoyed it. So next Wednesday, we will have Tyrone come back to our platform. So remember, Tyrone is actually the advisor for gap funding, and he has a class 4-part series on gap funding. He already talked about the first part. He will be talking about the second part. What is gap fund? Who is gap funding for? What kind of client you're supposed to look for gap funding? And we funded so many gap funding already. So again, next Wednesday night, we have the second part of gap funding. So again, thank you so much, everyone. Until then, we see you next Wednesday night. Good night.
All right. Thanks, everyone.
Thank you. That was great. Thank you.
Yeah. Good night.
Thank you. Appreciate it.
Thank you, guys.